Alright guys, so it's time we do an update on how the trade war is impacting the real world. Now we have been covering a lot about the US and China relations, but there's a bigger world out there, and everyone, especially exporters, are affected by this tariff war. Now when the US decides to stop buying your stuff, it's a game changer. Suddenly you have no choice but to reshuffle your trading partners. Trump's tariffs are going to shrink the world by $1 trillion by 2030. This is how serious things are getting. Now, the US itself is getting clobbered because consumers are simply losing steam. The latest retail sales data tells us everything that we need to know. US retail sales have declined the most since the start of the year. Buying in May fell by 0.9% month on month. The previous month's fall, April, was only a 0.1% decline. So buying is falling from an already low base. Trump's tariffs are having a material impact on the real economy. Now, when the biggest contributor to your GDP starts to contract, maybe it's time to start paying attention, just maybe. The tariffs are already making almost everything rise in price. Chinese goods are being brought in with a 55% tariff, and those will be passed on to the consumer. Now, I don't believe what Besson is trying to peddle, but the pain goes beyond just toys from Walmart. Remember Trump's steel and aluminum tariffs? Well, those are starting to take effect as well. You slap on auto tariffs, you have a recipe for disaster. Consumer budgets are about to tank. The average new car in the US has hit nearly $49,000 in April, and that's just 2 months of the steel tariffs in effect. We are on track to surpass the previous high in November 2022. And why are the prices still lower today? Probably because Ford and GM are eating some of the tariffs to shield consumers, but that won't last forever. In fact, in May, the recommended retail price has already been nearly $51,000. Just wait till June, I bet consumers will be paying at least $52,000, maybe $53,000 for the same car. Now, as an exporter, someone who sells to the US, you know what's coming up. A demand collapse for your goods just from domestic consumption alone. And we aren't even factoring in Trump reinstating Liberation Day tariffs. Now, despite the Iran Israel escalations, the US dollar is still getting clobbered. Now, this is also a big point of contention for global exporters. Investors are still betting against the reserve currency. According to Bank of America, global fund managers are still heavily short the dollar. June short positions were the heaviest since January 2005. Even the best in 2008 after the bailouts were more bullish than today. It's literally crazy. And it's simple to understand why. Even after the real estate collapse, the underlying economy was actually solid. Wall Street was in trouble, but Main Street, especially US tech companies, were doing pretty well. So the bailout was helping to revive an economy that took a heavy left turn, but the fundamentals were still fine. Most importantly, debt to GDP was still 40%. The US hasn't run up such a huge deficit yet. Today, the figure is close to 100%, and that's why the dollar was still fundamentally fine in the past, but today it's a whole different story. Now, imagine you're exported to the US. There are two big worries. Now, the first is a declining trade with the US. You need to shift exports to where new demand centers are, and they will be undoubtedly Europe, the Middle East, and especially Asia. And that's where the biggest drivers of growth will be. And we best understand how much share the US will be losing under Trump's new trade regime. America's trade with Asia will determine the future, and the future is not looking bright. US trade with the region will drop by over 2%. China, on the other hand, will gain around 50 basis points worth of market share or half a percent. And when China does more trade with the world, they don't really want to transact in dollars. They would rather trade using their own local currency, the RMB. And worst case scenario, they would use the local currency of the trading partners. And whether that is rupees, rubles, or euros, China would rather use those. It's still considered a form of de-dollarization. And that's why the following report shouldn't be a surprise to anyone. It's par for the course. And a major US bank is now sounding the alarm. The head of their currency sales is saying exporters around the world they are rejecting dollars. They just don't want to buy it for their trade settlements or transactions. Now, this is a big repudiation of the reserve currency. Global exporters are a big source of demand for the dollar. They need it to buy and sell stuff, not just with the US, but with other countries. But Trump has thrown a big wrench to the supply and demand dynamics. Suddenly, holding greenbacks is making less and less sense. And according to global exporters, they are asking for settlement in euros, the Chinese RMB, the Mexican peso, and the Canadian dollar. But here's the main concern: exporters now just want their own currency. The fear of dollar volatility is triggering major concerns for their earnings. Now, not every company exports services that have ridiculously high margins, right? Some margins can be as low as 5 to 10%, especially after the tariffs. The dollar falling by 5 to 10% can wipe out any profits. Exporters might even go into the red. This is a technical reason why exporters are shunning the dollar. It has nothing to do with sanctions, nothing to do with US threats as well. A collapsing currency alone makes it risky to hold. Now, despite all the geopolitical risks, the dollar today is still worth 9.4% less than it was since the beginning of the year. And within the next few months, it could drop even more. Now, as a supplier, you don't get paid right away. The terms of payment can be anywhere from 30 days to a few months in extreme cases. And if your payment currency of choice is dollars, then you might be screwed. By the time you receive your money, your local currency might be stronger than the dollar, so converting it over will result in a loss. And that's the big dilemma exporters to the US are facing. Essentially, they might be working for free to sell stuff to US consumers. Doesn't make sense at all in any calculation, and hedging the currency risk, guys, that takes a lot of money as well. And that's why the rush away from the USD is happening. And here's the funny thing: it's not only the exporters that want to bypass dollar transactions, buyers from other countries, sellers, are also encouraging the move away as well. Even US companies are de-dollarizing. A Midwest lumber company is converting their dollar cash into euros before paying for hardwood imports from Europe. Normally, US importers would pay in the dollar, which makes sense, but the EU supplier offered a 2% discount for payments in euros, so even American companies are being forced to de-dollarize. And the same thing is happening with imports from China. Chinese suppliers, they are demanding RMB for trade payments, and they are willing to give better terms to US companies. It's really wild, but this is the consequence of Trump's tariff war. Everyone starts thinking of de-dollarizing. Exporters do it to prevent a loss, importers are doing it to get a discount. And doesn't take a genius to see where this is heading. It's very bad news for the US. Global trade will get more de-dollarized, and the longer this tariff war continues, it will just get worse. Now, this might come as a shock, but outside the US, the majority of exports aren't priced in dollars. Trading is being done in local currencies, with the euro actually being the leader with 50% market share, more or less. The dollar, however, is less than 40%. And this is data from 2023. In a few years' time, we'll get the full extent of the dollarization. We can expect the dollar share to drop and China's RMB trade to increase. And when that happens, we'll see Scott Bessent cook up a new scheme to protect the dollar's dominance.
Yes, sir. And also, the digital assets are an important source of innovation that will drive that can drive usage of the U.S. dollar around the world, as with stablecoin legislation. There is speculation that there may be up to $2 trillion of demand over the next few years for U.S. government securities from digital assets.
And boy, must he take the ball and run, and he better run fast. Less dollars used in trade means less money entering US markets and treasury bonds, not good for the borrowing situation. In a very predictable report, more central banks than ever are planning to stockpile even more gold. There are just too many worries countries have with American assets today. Now, this is despite record gold prices. Don't forget that bullion has risen by over 30% year to date. For any other asset class, buyers would be worried. In fact, money managers would be trimming their positions and reallocating elsewhere. But gold is more than just a ticker symbol in a portfolio. It's real money and has zero counterparty risk when dealing with Washington. The World Gold Council did a survey and the results are really telling. Central banks around the world were asked if their reserves as a whole will have more gold inside. Now, the majority in 2025 said either moderately higher or significantly higher, and the trend is unambiguous. Since 2022, demand for adding gold has only risen higher and higher. So if you're a gold investor, this is good news because a big bid in the market will still be there helping to support prices. But the next part of the survey gets really interesting. Central banks were then asked about their holdings of US assets, reserves held in US dollars. And we have the exact opposite happening here. Now, back in 2022, trust in dollar assets was shaky, but the majority would not dump their holdings. But 3 years later, things have changed drastically. 45% of central banks will be divesting their dollar reserves 5 years from now in a moderate way, but 28% see their dollar assets significantly lower down the road. Now, I'm not saying that they will dump every single dollar asset. For diplomacy, they can't do that. It will incur the wrath of Trump and the US government and all their machines. The absolute amount will still increase, but in percentage terms, it would most definitely drop. And just like you and me, central bankers are humans. They also understand what's going on in the world. As such, their allocation decisions are greatly affected and influenced. They are witnessing how destabilizing the US economy is becoming not just to itself, but to the world as a whole. And when you keep borrowing money and you're on the brink of endless wars, people tend to take notice. People aren't blind. The world isn't blind and they're starting to react in a very big way. Now, when asked about the topics that influence their reserve decisions, central bankers listed this amongst their top five. We have inflation concerns, geopolitical risks, and Trump's global tariff war. And that's why they're buying tons of gold every single year and some of them every single month. US trade policy, their fiscal policy, and even foreign policy is leading to one deadly eventuality: monetary debasement of the currency. Over time, the dollar is going to get weaker and weaker. So central banks are stuck with a very binary choice. Other countries' debt isn't as liquid as the dollar yet. Even the euro debt market isn't deep enough. So it's either dollar assets that exposes you to a triple threat or buy gold and safeguard your value. And according to JP Morgan, the dollar today is still very expensive, and that's despite the recent tumble in value. The real effective exchange rate is over a standard deviation higher, and if we get back to just the average, it will take another 10 to 15% crash in the dollar index. Now, will it be a good time to buy dollars after the collapse? Now, frankly, I don't know. Maybe it is, maybe it won't be. We'll have to recheck the fundamentals of the US economy then, but central banks around the world aren't going to take the chance. They have to worry about the here and now. They need to diversify just in case a bigger crash comes. Now, Trump's tariff war has truly changed everything. Him also thinking of starting something with Iran, something bigger, just makes things worse. But let me know what you think. Will dollar confidence ever recover? And will central banks continue stacking gold? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.